Please type your questions in the chat. We don't usually check the Q&A. Yeah, you'll be able to rewatch the lesson for 48 hours, I think so. Yeah.
Are we able to rewatch? Yes.
The next class is on Tuesday.
Yep.
Sunday, Tuesday.
Agrees to sell shares at the
and where it is on the graph and its historical data, stuff like that, stuff in my opinion that you can't really get from the fundamentals. But I do use fundamental analysis often, especially with dividend stocks. It's a fair pricing is key. Traders are looking for stocks that are undervalued and overvalued. And extrinsic value plays a huge role into fundamental analysis, and we will go over extrinsic value. But to make a long story short, you use extrinsic value all the time, where let's just say you buy a house, you believe it's priced at $600,000, but it's at $650,000. So you have a choice of either, waiting for the price to drop or just buying at it and hoping that you can catch, an uptrend, if that makes sense. Hoping that the housing market goes up. See, extrinsic value is just picking a value of something and either choosing to buy at that value or waiting till it drops or goes higher. That's all it is. So for a summary, that's basically talking about extrinsic value, technical analysis, fundamental analysis, which I already said. Fundamental analysis is all about balance sheets, reading the company's, history and just looking deep into the companies. And we will be going over that, I think, day 5, fundamental analysis. It's a full day where we teach fundamental analysis. So that's the funny part people don't know about AMU. We don't just teach technical. We do have a full day of straight fundamental analysis. So I'm going to let Mike get to his part, and I hope you guys enjoy day 1.
All right, can you guys hear me? You have to turn the sound off. What about now? How's the sound now? Perfect. And you guys, you can see my screen and everything? Perfect. Okay. Yeah, so, welcome to AMU University, Aristotle Money Mike Unraveler. This is week 1, day 1. We have an entire month with you guys, so, we're going to teach you guys a lot of information. Make sure you take notes. I highly recommend you take notes, and you guys are ready for, it's going to be a lot, and it is an entire month, so it's not that fast, but get ready to learn a lot of information in a short period of time. Anyway, welcome to day 1. Today, I'm going to be talking about the basics of what kind of accounts you have to open when you start a trading account, and what brokers I recommend, and what are your options as far as brokers go. So cash versus margin. When you guys open a trading account, you're going to have the decision of a cash account versus a margin account. A cash account does not have a restriction on how many day trades you can make. You can trade the funds available in your account until they are no longer available. Shares take 3 days to settle. So that means I'm going to give you guys some examples, but if I say that it takes 3 days to settle, then let's say you have $5,000 in your account and you buy 3 shares of Apple, like actually the stock. So you're actually buying 3 shares of the stock Apple and then selling that 3 shares. The money that you use to buy that Apple shares will not be available for use for 3 days. But if you're buying an Apple call, so you spend $500 to buy an Apple call, which is an option, right? Then that money on a cash account will settle overnight. So you'll be good to use that money that you used to buy an option the next day. All right, so shares, buying equity, and selling equity, shorting equity, that takes 3 days to settle. You have to wait 3 days to be able to use that money again on a cash account. But buying options, you have to wait overnight. And then after the cash is settled, you may trade with those funds again. Zero problem. So here's an example for you. If your account has $1,000 in it and you buy an Apple call worth $300, you now have $700 to trade with for the rest of the day. The next morning, the profit or loss you took on the $300 Apple call will be ready to use again. So if you have $1,000, you buy an Apple call, it's $300 and you make $100 profit, right? So now that's worth 400. You made $100 profit. So now your account is at $1,100. The next day, literally overnight, the next day, you'll be able to use that entire $1,100 to day trade with again. So that's the benefit of cash accounts. You don't have, a certain amount of day trades. The problem with using a platform like Robinhood, Robinhood is the very basic beginner application that most people start off with, but they don't offer cash accounts. So you got to find something like Tastyworks, Thinkorswim. I'm about to show you guys all the brokers, but if you don't use something like that, then you won't have access to be able to trade every single day trade. So I highly recommend, if you have less than $25,000 in your account, that you guys open a cash account to start day trading. So margin accounts under $25,000 are restricted to 3 day trades within a 5-day period. Most brokers give you the option. You can choose between cash or margin. But if you go to a basic broker, like I said, Robinhood, then you're going to be restricted to a margin account. And the problem with that is if you have less than 25,000, then you can only make 3 day trades within a 5-day period. Over $25,000, if you're on cash, you're on margin, you have unlimited day trades. Unlimited day trades on a margin account. So if you have over $25,000, I highly recommend opening a margin account to start out. Margin accounts allow you to borrow money. That's another benefit to a margin account. They allow you to borrow money in order to leverage positions. Now, you can't borrow money for option trades, but you can borrow money for equity. So if you want to buy, right, let's say you have $25,000 in your account and you want to buy into a $100,000 equity position on Apple, you can, and you could day trade that. And that's a big difference. That's 4 times leverage. So if you have over $25,000 in your trading account, then I highly recommend a margin account. So which is better and why? I mean, the answer is simple. It's very simple. If you have less than $25,000, go to a cash account. If you have more than $25,000, go to a margin account. Very simple. So I'm going to be talking about the different brokers that you guys could use. TD Ameritrade is very popular in the in the trading world. I actually have been using TD Ameritrade for a couple of years, but I actually just switched because they're having a lot of problems. But like I say here, so it's very popular by retail traders. It allows, you can open a cash account, you can open a margin account, you can trade options, you can trade stocks. It really is a great platform. There's a lot of features to it. The interface is free. So when you open that account, you'll have access to this beautiful, beautiful interface and platform free with that account. There's also a very nice mobile app. It's easy to use on iPhone or Android, whatever. It's $0 commission fee for stocks. And then depending on how much money you have in your account, there is a variable commission for options. It starts at 65 cents per option contract, which really isn't that bad. You know, so if you buy 10 contracts, then that'll be $6 commission. It's not that bad. The only problem is TD Ameritrade, in my opinion, and if if you're in the trading world, then you'll probably hear the same. It's been declining in speed and reliability so far in 2020. Actually, like 2 weeks ago, it just didn't work for the entire day. The TD Ameritrade application was down. It didn't work. You know, the entire morning, you couldn't even get into or get out of a position. And that's a huge deal. I mean, if you're actually trading size, you know, you're trading large amounts of money, then you need to make sure that your platform works. So when that happened, I realized I had to change brokers. And now I'm working with Lightspeed, which is another broker I'm going to show you guys. But the account minimum for Lightspeed is $30,000. So I'm gonna show you guys that though. And then the customer service, honestly, for TD Ameritrade is not great. It kind of depends on how much money you have in your trading account though. You know, with the rest, that's how life works though. You know, they obviously will treat you better if you have more money in your account. But I will say, you know, sometimes you could be on hold waiting for customer service 30 minutes, 45 minutes, an hour, waiting for them to actually answer your call. But it's not bad. I mean, I love the platform. TD Ameritrade, Thinkorswim, beautiful platform. The mobile app is amazing. I love trading on Thinkorswim. I love trading on TD Ameritrade, but I had to switch platforms due to the fact that they were just not filling orders in the morning. It's very important. Tastyworks is another good platform. A lot of people use Tastyworks, and the chat, it's a brokerage, you know, that's their saying. It's a brokerage from the brains behind Tasty Trade, Tastyworks. So they also have option and stock trading, so you can buy and sell shares and you can buy and sell options. They do have great execution and customer support. The platform's a little basic. I mean, in my opinion, it's a little basic and confusing. And then it's $1 per contract option commission, and that's capped at $10. So you know it's $1 per contract, but it's capped at 10. So if you buy 100 contracts, you're still only going to pay $10. So it's not terrible. A lot of people seem to enjoy Tastyworks. It's just not a very elite platform. So it depends. You know, starting out, no problem at all. I recommend Tastyworks or TD Ameritrade. But if you guys are dealing with, you know, higher amounts of money, $50,000, $100,000, then I recommend one of these other platforms that I'll be going over in just a second. Lightspeed, beautiful. So this is actually a newer platform, a newer broker that I actually just switched to because of the problems that I was having with Thinkorswim. But Lightspeed is amazing. It has a beautiful platform, access to level 2, times and sales. It is a short locator. So that means I'll be going over what short selling stock actually means, but they have a locator. So, you know, if you need to find shares to short, you have to borrow shares to short, then this platform actually has that available. And then the execution is direct. So you're actually buying and selling your orders direct to the market, and you can actually hide your orders. So, you know, a lot of problems that Thinkorswim has is that you're going into the market, you're buying and selling into the market, and those orders are available for market makers to see. And I'll be going over that later in the course as well, more direct. But with Lightspeed, you can hide your orders, which is nice. So if you don't want anybody to see that I'm buying 100 contracts of Apple, then you can hide that. You know, if I want to block trade, I want to buy 50,000 shares of Lululemon, then I can hide that order. So the execution is direct to the market, and that's one really nice feature of Lightspeed if you are trading larger capital. And then, you know, like I say here, so you can make hidden orders to keep off the tape and hidden from market makers. The The commission isn't bad. It's 60 cents per option contract and 0.004 cents per share, which is like nothing. I mean, that's not even 1 cent per share. It's nothing. The only problem is, like I said, the account minimum is 25,000. Cobra trading, this is a good one. If you guys are, you want to trade equity or you want to trade options, this is more of the equity side. I don't recommend this platform for options, but if you are interested in trading equity, this is the best platform for equity traders. It has an incredible short locator, so you can find very hard to borrow stocks that are available to short. It's 0.004 cents per share commission and 50 cents per option contract, so not bad. And then the platform is very solid and attractive. I have a lot of friends who use this. The only problem, there you go, account minimum 30,000. So if you want to focus on equity and you have that account minimum of 30,000, this is definitely the way to go. But if not, then I recommend Tastyworks, TD Ameritrade, and a couple of the other ones I'm going over. TradeStation, very advanced platform with elite level 2 and market depth. TradeStation is nice. I used it for about 6 months a couple years ago. The only problem is that they have expensive monthly fees for data, and who likes to pay monthly fees? I don't. Subscriptions, you have to pay monthly fees for those. So that's the only problem with them, but it is a very advanced platform. I recommend checking out every platform until you find something that really works for you. They do have a $2,000 account minimum, and then Robinhood. So Robinhood is a very simple user interface. It's probably the most common among retail traders, Robinhood starting out, but it's probably the worst. It's probably the worst application ever made for traders, if I'm being honest. I mean, so here's the benefit, right? It's $0 commission fees on stocks and options, but they have horrible customer service. They have horrible execution and lag. And honestly, so if any of you guys were around in March this year, there's actually shirts that were made that said, "I survived Robinhood outage of March 2020." And that's because the platform did not work the entire day. So people had open positions. They had like Amazon contracts, $100,000 in contracts, and Robinhood just didn't work. Like, you couldn't log on. There's no one to call. There's not a number. You can't call Robinhood. It doesn't exist. You have to email them. So who knows when you're going to hear back about that. The customer service is trash, right? Like, absolute trash. I know people who lost $60,000 that day in March, and the customer service said, we'll give you a gift card. We'll give you a gift card. So I highly do, it's the worst application possible when it comes to customer service, when it comes to execution, and when it comes to lag time. I do not recommend Robinhood unless you are swing trading. Then it's okay. It's okay for swing trading. But like I said, do not recommend. 1 out of 10 recommend. Even though it's the most popular, do not recommend. And then Bloomberg, last but not least, I personally use Bloomberg. It's actually the most advanced and elite platform in the world. If you walk into a hedge fund in New York, you walk into a hedge fund in London, Chicago, Dubai, they're going to have a Bloomberg terminal. It provides the most live news possible before any other news source. It provides in-depth market data and company information. Here's the problem. Expensive, very expensive. So it's $27,000 a year, and you have to sign a 2-year contract. So it's about $2,400 a month. You know, if you have it, then you can go for it, right? But it's very expensive. So, you know, unless you're making like upwards of 400,000 a year, then I would not recommend getting Bloomberg Terminal. If so, get it. It's the best. That's it. That's all I have for brokers. I mean, obviously, there's a lot more brokers out there, but those are the ones that I know well. You know, those are the ones that I hear about the most and that I have actually personally tried. Starting out, I really recommend that you're going to, I really recommend trying Tastyworks, TD Ameritrade, and maybe Lightspeed if you have the money for that. Try out TradeStation. I mean, just try out a few different brokers and see what actually fits for you. And I'm going to give you guys a brief summary of fundamental analysis. I have an entire section on this in a future course, but for today, I just want to kind of break it down very simply so you guys have a basic understanding for the next class. All right, so fundamental analysis is the stock market analysis of breaking down a company's financial information to find intrinsic value versus market value. It requires an in-depth study on a company's past performance, present performance, and future expectations. Yahoo Finance provides a great rundown on every company's financials and balance sheet. So if you look at this picture above, this is an income statement. You can also see the top income statement, balance sheet, cash flow, right? So I'll be going over this, but this is just the basic, very, very, very basic entry level to what actually is fundamental analysis. I hope you guys enjoyed day one. You know, it's just, we have to get the ball rolling. So we'll start out with entry level information, and then we'll keep going more in depth, and, you know, take you guys all the way. You know, we have you guys for the entire month of September. So this is going to be an amazing class, and I'm excited to help you guys take your trading to the next level. I'm going to pass this off to Unraveler now.
Thanks, Mike. What's up, guys? Hope you guys can see my screen. I'm having a great weekend. Welcome to AMU University, day one. So today, I'm going to be giving you guys an introduction to options trading. We're going to be learning a lot today, so I highly recommend that you guys take notes. It's going to be a lengthy presentation. I'm going to take the rest of the time. And if you're really new to options and if you're like unfamiliar with the terms that we're using, I'll be going over as slow as I can. So please do take notes, screenshots, whatever helps you. And at the end of the lesson, we'll be having a question session. You can ask me any questions related to this lesson. Okay, let's get started. So the table of contents for today's lesson, first I'm going to be giving you guys an introduction to financial instruments, then what are options, characteristics of an option contract, different types of options, understanding options pricing with examples. Then we're going to be going over writing options, and I'm going to be covering some examples to help you understand this concept. And lastly, why do we trade options? Okay, let's get started. Financial instruments. So what is an instrument? They are a means to an end. To make music, you need a musical instrument. To watch a movie, you need a television set. Similarly, to transact in the financial markets, you need a financial instrument. A financial instrument is nothing but a financial contract between two interested parties. They can be created, traded, modified, and settled. In a nutshell, financial instruments are means to exchange money in the market. So this is just a basic terminology of the market. So a lot of times people don't understand what is an instrument, what is a stock, what is an option. they all come under the classification of financial instrument. So if you want to do anything, you need an instrument. So for music, you need musical instrument. Similarly, if you want to exchange money in the market, that is, if you want to transact, let it be stocks, let it be some kind of contract between two different parties, uh, exchange stocks, exchange bonds, exchange future contracts, exchange option contracts, stock option contracts, whatever it is, you need a financial instrument. And today we're going to be talking about option contracts, which come under a different category of financial instruments called derivative instruments. So what are the two types of instruments on a high level? Financial instruments can be classified either as cash instruments or derivative instruments. There are two types on a high level. So what are cash instruments? Cash instruments are those that the markets value directly. Example, stock. So what do we mean by that? The markets value directly. So let's take a stock, let's take Apple. Everyone knows Apple, the company. The stock's listed under the NASDAQ. So Apple stock, how do you think its value is derived? The market values Apple currently at, I think, at 110 or 115 or 20, something like that. Now, how do you think the value is determined? The market's putting some value there, and the valuation for Apple is determined by a lot of factors. Number one, it may be due to their income that they generate, their revenue, their cash flow. There's a lot of things behind their the moving parts of the company. They can be some kind of news that's coming in, the future projections, future revenue coming in, news acquisitions, politics, elections, a lot of things play into a part of valuation of a company. And the market decides what that value is of the stock. Those kinds of instruments are what we call as cash instruments. So an example for that is stocks, bonds, loans, etc. are considered cash instruments. Okay, the market values them directly based on supply and demand. First, from a technical standpoint. From a fundamental standpoint, it may be their income, it may be due to their revenue, fundamental side of things, it may be election, news, or some kind of catalyst. Okay, so that's cash instrument. So what are derivative instruments? So from the name, you can kind of understand that there's a word derive here. So derivative instruments are those which derive their value from movements of an underlying entity such as stock, bonds, etc. So key distinction between a cash instrument and derivative instrument is that cash instruments, the market values them directly. But for derivative instruments, they don't have any value of their own. Their value is derived from movements of the underlying stock or bond. Meaning, if the stock price goes up, the value of the derivative instrument, that's our option contract, it's going to change based on the value of the stock. If the stock price goes up, then our option contract's value is going to change based on the movement of that stock. Okay, so based on the movement of the underlying entity, like a stock, our derivative instrument's value is going to be determined. Okay, an example for derivative instrument is an option contract, future contract, and other kinds of derivative contracts. Okay, so those, in a nutshell, that's financial instruments. So if you want to conduct any kind of transaction in the market, you need to use one of these financial instruments. Since we're in the stock world, we're going to talk cash instruments related to stock. For derivative instruments, we're talking about options. Okay. Now, number two, what are options? So we discussed about derivative instruments briefly. So an option is a derivative instrument that specifies a contract between two parties for a future transaction on an asset at a set price within a specific date. Okay, so let's break this down. We know that option is a derivative instrument. It does not have any value of its own. It relies on movements of the stock to get its value. So the stock price moves up, the options contract is going to change in its value. If the stock price moves down, the option contract's value is going to change in value. We're talking about stock option contracts here. Okay, so that's why it's called a derivative instrument. Now, what is a contract? So an option contract is a contract between two parties for a future transaction on an asset. The asset in question here is a stock at a set price, meaning we have a price, the contract is set for a specific price, and we have a specific date where the contract is valid. Okay, now let's take a look at a more relatable example so that before we look at a stock example, let's look at a more relatable example here. But first, let's go over this definition. So what is an option contract? An option is a contract that gives the buyer the right, but not obligation, to buy or sell the underlying asset or security at the agreed price within the agreed time. Okay, so there is a price constraint and a time constraint, and the asset in question can be a stock, since we're talking about stock options, and can be a buy or sell option contract. Okay, and whatever contract is agreed upon, it gives the buyer the right but not obligation, meaning the buyer can choose to either buy or sell that option contract, meaning buy or sell the asset in question, but is under no obligation to do so. Okay, so if you get into a contract with someone, an option contract with someone, and you have an option contract, say call option contract, you have the right to buy or sell the shares, but you don't under no obligation to do so. Now, let's take a look at this example here. So we have two friends here, Barry and Sam. Okay, and there is a Nike sneaker that Barry really likes, and Sam has that Nike sneaker. So what Barry does is he reaches out to Sam and says that, hey, Sam, I want to buy that sneaker for $300 by the end of September. Okay. Now let's assume that this sneaker is currently valued at 300. Okay. So then Barry signed this agreement with, that is the contract with Sam. He said that I'm going to buy the sneaker from you for $300. That is the agreed price. And by the end of September, that's the agreed time. Okay. And the asset in question is this Nike sneaker. Okay. And Barry decided to buy it. Okay, so Barry has a contract to buy the sneaker for $300 at the end of September. I hope that this is clear for now. All right, so now what happens 2 weeks after this contract is agreed upon, or 2 weeks after Barry signed this contract, some major NBA player decided to sport the sneaker. He decided to wear the sneaker, and that caused demand to rise. So because that famous NBA player decided to wear the sneaker, the demand for that sneaker shoots up. And this sneaker is currently valued at, the price of the sneaker is currently $450 because of the demand. Okay. Now, since this contract is already agreed upon by Barry and Sam, that gives the right to Barry to buy the sneaker still at $300 by the end of September. Okay. This contract is agreed between Barry and Sam, so he can still buy the sneaker for $300 at the end of September, even though the current value of the sneaker is $450 because of the recent demand surge. Now, Sam, on the other hand, is the one that's supposed to sell this, so he has an obligation to sell this sneaker for $300 by the end of September if Barry decided to buy it. So Barry's a buyer, he has a right to buy the sneaker by the end of September, and Sam has an obligation to sell the sneaker to Barry as the seller. Okay, I hope this concept is clear. Now, if you just substitute the sneaker as a stock, so let's say this is an Apple stock here right now, and you buy an Apple call option for the end of September. Now, the Apple stocks due to, let's say Apple releases a new iPad or whatever it is, they release something, and some analyst at JP Morgan says that, hey, this iPad is going to change the world, and stock price is going to, we're projecting a stock price rise of about 20%. We're projecting a 20% rise in revenue, and the stock price is expected to reach a target of, let's say, 150 by the end of the year. It says something like that. Now, that's going to cause the stock price to rise. And if Barry has a cheap contract for Apple, and the stock price continues to rise, Barry has the right to purchase that Apple stock for a cheaper rate, cheaper value based on the contract that he signed. Okay, so that's the power of option contract. It gives the buyer the right to buy the asset in question, that's the stock, at the agreed price within the agreed time. Now, when you say buy, it's a call option contract. I'll explain that in the future slide. But it depends on the type of contract. If you buy a call option contract, you can buy the shares of the underlying security. But if you buy a put option contract, then you have the right to sell shares of the underlying security at the asset price specified in agreed time, which I'll cover later. But I hope that you guys understood the concept of option in general, like based on the sneaker transaction. Essentially, it's a contract between two different parties for a future transaction on an asset at a set price within a specific date. The asset in question can be a stock, and the set price we'll cover that. It's called a strike price. And we have a specific date tied to that contract. Okay, so the key takeaways here is the option buyer pays for the right to complete the transaction but is under no obligation to do so. In this example here, Barry has the right to buy the sneaker because of the option contract he signed, but is under no obligation to do so. That's why we call the term option, because it's an option, it's not an obligation. Okay? Now, agreed price. All option contracts has an agreed price. This is the price at which the option buyer can buy or sell the underlying security. This is also known as the option strike price. So in this example here, $300 is the price both Barry and Sam agreed for the sneaker. And that's what we call as agreed price. And this is a stock option contract. 300 over here would be the option strike price. And agreed time. All option contracts has a time constraint, and that's what we call as agreed time. So this is the expiration date of the option, and the option buyer has the right to exercise their option by this date. Okay, so that's an introduction, a short introduction to option. I hope that this was relatable. We'll be learning about options throughout this course, so don't feel like this is like we're not giving enough information right now. The next few slides are going to be covering what call options are, what put options are, and what these different terminologies, these different terms that I'm using mean. So hope you guys understood this, and moving on to the next slide. All right, so throughout this lesson, I'll be using certain terms, and as you get into trading, you will be coming across these terms a lot, especially if you join any trading community. You'll be hearing, especially if it's an option community, you'll be hearing terms like buy, call, option, strike, so-and-so, and I'm buying this many contracts. So you may hear about a lot of things, and as a beginner, you may be already trading options by now, but there are a lot of beginners in this course, so we'll be going over some of the basic stuff. So please pay attention if you're a beginner. Strike price. So that's a term that we just discussed. All stock option contracts can be associated with a strike price. This is the price at which an option holder can either buy or sell the underlying security, that is depending on the type of option contract. So in this example here, $300 is the price they both agreed on. That's the agreed price. That's what we call as a strike price. Okay, all stock option contract has a strike price. And contract size. So this refers to the fixed unit of shares that each option contract holds. The contract size for a stock option contract is standardized at 100 shares. So for each option contract, the option buyer reserves the right to buy or sell 100 shares of the underlying stock at the strike price by the expiration date. Now, so when we say we're buying one contract of the sneaker, okay? So that means that one contract can be equated to 100. The standardized contract size is 100 for the US stock options, okay? That's decided by the options exchanges, the Chicago Board of Options Exchange, and the CBOE. So what that means is that each option contract has a lot size of 100. So if you buy one contract, you have the right to buy 100 shares of the underlying security. Or if it's a put option contract, you reserve the right to sell 100 shares of the underlying security. Okay. Now, if you're trading from somewhere else around the world, I know that we have a lot of people from different parts of the world. The contract size may be different for your exchange or country, because in the US, one stock option is 100 shares. If you're from Europe, it may be 75. If you're from India, it may be 75. It depends on the instrument that you're trading. It's decided by the exchanges. So please just look into where you're from and see what the lot size or contract size is for options in that market. Okay. What is an option premium? Option premium is the price of an option contract. This is the price you pay to buy an option contract. Now, we said that there's an option Barry and Sam agreed upon, but in order to get that option in place, in order for Barry to purchase an option, he has to pay a certain amount. So option premium is the price of an option contract. So this is the price you pay as a buyer to the seller of an option contract. So if this option is established, Barry would have to pay a certain amount as an option premium to Sam to get this contract in place. Okay. So as an option buyer, all of us will be option buyers when we're trading in the market. So if you're an option buyer to purchase any option contract, let it be a call option contract or a put option contract, you need to pay a certain amount to buy that contract. That amount is what we call as option premium. And a key important point over here is option premiums are quoted on a per share basis, meaning option premium needs to be multiplied by 100. Remember, I said that the contract size for each contract is 100 because of the fixed unit of shares, the lot size is 100. So whenever you see an option contract, the price will be, so let's take this example here. So the premium for $280 call option is $5.25. Now that does not mean that you're just paying $5.25. Remember, one contract is equated to 100 shares. So every time you see a premium quoted in any platform, that needs to be multiplied by 100. So $5.25 contract is actually worth $525 per contract. Okay, I hope that that's clear. So that's option premiums are also always quoted on a per share basis. So if you see a dollar value in your option trading platform, that needs to be multiplied by 100. When you click confirm, you would notice that the actual price of that option contract is $525. Okay, so that's an option premium. So what is an expiration date? Remember, all option contracts have an expiration date tied to it. All derivative instruments do. So that's the expiration date is the day the option contract expires. Most stock options have weekly, monthly, and quarterly expiration dates. So what's the significance of expiration date? So that's the day actually the contract expires, meaning that's the last day where the buyer and seller can complete the transaction. So on option expiration date, option owners, that is the option buyers, will have the following choices. So number one, if they're just like looking to day trade that option, they can sell that option contract to another buyer on the market and realize profit or loss. So this is what we do. So let's say the option contract expires on Friday last week, and on Friday morning we have that contract. We bought that contract. We can either sell it to another buyer on the market. That is, let's say we're day trading that option contract. We could sell it to another buyer in the market and realize profit or loss. If price moved in our favor, we would make money. If price didn't move in our favor, we would take a small loss and sell it for a loss to another buyer in the market. Okay. So when I say another buyer in the market, so anytime you complete a transaction, let us you buy stock, buy option, whatever it is, someone should be willing to sell it to you, number one. And if you're trying to sell something in the market, someone is should be willing to buy it from you. So that's what I mean by that. All right. And so that's number one. That's one of the options that you have on the expiration date. Number two is you can actually exercise the option contract to purchase shares of the underlying security and realize profit or loss. Now, if you have a call option contract, and let's say the option is actually the price of the stock is moving in your favor, you're already profitable. So you decided to exercise your option to purchase shares of the underlying security. So you can do that on expiration date and realize profit or loss. Okay, so that's another option. Third option here is you can let the option contract expire worthless. So what that means is, let's say you are on option expiration date, you have a call option contract. You can try to sell it to another buyer in the market, but if there's no other buyer in the market, meaning no one else out there is willing to purchase that option contract from you, then that option contract is going to expire worthless if it expires out of the money. Okay, so that's another thing that's another scenario that can happen on option expiration date. You will understand this concept more later in the slide when I cover that. All right, so there's one more thing about expiration date. Since we have a lot of people from different parts of the world, US stock options can be exercised anytime before expiration date. So if you buy an option contract now, tomorrow or Tuesday, you can actually exercise it on that very given same day. But if you're from Europe, or if you're from India, if you're from anywhere else around the world, you may actually be restricted and only be allowed to exercise it on the expiration date. So that's a restriction in many parts of the world and is still honored. So it depends on where you're trading at, what kind of instrument you're trading at. These rules may change. Okay, just an FYI. All right. So this is another important concept. If you're someone that's looking to exercise options, you need to know about break-even price. So break-even price is the price level the stock must break above for call option or break below for put option by expiration date for the option holder to realize profit, assuming the option is exercised. So as the name implies, break even, meaning you buy something and you're not making money, but you're also not losing money, then you're breaking even on that position. So that's what the general definition of that term is. But in options, there's actually a slightly is the same definition, but you'll understand this concept more once I talk about this example. Now let's take a look at this example here on my screen. AMD is a semiconductor company, and let's say you decided to buy AMD $42 call option for $1, meaning you're paying $1 into 100, that is 100 bucks to purchase $42 call option for AMD. So what does that mean? You're just buying the right to buy 42 AMD one share, 100 shares of AMD at $42 per share. That's what this call option means. Okay. For a future date, you have the right to purchase, complete this transaction. Now, there is a formula to calculate the break-even price. So for call option, it's strike price plus the premium paid. For put option, it's strike price minus the premium paid. So strike price is over here, we know $42 is the strike price, and premium paid is the amount you're paying for that option contract. So the break-even price for this call option contract is 42 plus 1, that is $43 per share. $43 is the break-even price. Now that we know what the example is, let's look at what happens on expiration date. So on option expiration date, meaning that's the last day when the contract expires that for AMD. Now let's say AMD is currently trading at $43. Okay, so it was $40 when we first bought this contract. The share price went up $3, and now it's trading at 43 on expiration date. So you have the $42 call option, meaning you get the right to buy shares at $42 per share. So you decide to exercise your contract and buy 100 shares of AMD at an average price of $42 per share. Okay, so just simple math here. The current price of AMD is $43, and you have the right to buy AMD at $42 per share. So your play is already in the money. So you're meaning you're already profitable. So 43 minus 42 into 100, meaning you have 100 shares. So your profit is $100 at current market value. Now the AMD price continues to go up, your shares will also continue to go up in value. But there's always a but here. But the premium you paid for the option contract in the first place is $100. So to purchase this option contract, you paid $100 in the first place. So what happens here? So the net profit and loss for this transaction. So you decided to exercise your contract and purchase 100 shares of AMD, but you paid $100 in the first place to purchase that contract. So profit minus premium, that's profit is $100 for that share, and premium paid is $100. So $100 minus 100, you broke even, $0. You didn't make any money from this transaction. So to break even, the stock price must be at $43. So that's the formula here. Okay. So when will you actually realize profits? So when will you actually be profitable in this trade? To realize profits, the stock must break above the break-even price for call option. So the stock price was at 45 or 44 when you decided to exercise this. So your stock price is going to be increasing. So meaning your profit is going to be increasing. So if it's at 44, you make $200 in profit because of the share position, and you just pay 100 in premium. So 200 minus 100 is you're profitable by $100. And if the stock price is at 46 minus 42, that's $4, 400 minus 100, 300, you're $300 profitable when you exercise this contract. So the lesson here is that you need to realize when you as an investor hold an option and you want to exercise your contract to purchase shares, sometimes it makes sense to just exercise and purchase those shares, but you need to always be aware of the break-even price and make sure that your current position, the current value of the stock is trading way above the break-even price, because that's when you actually realize profits. If you're at the break-even price here in this situation here, you're at the break-even price. AMD is at 43. So in this case, You might just sell your option contract for profit. That is, just sell this position to another buyer in the market and just buy those shares at current market value. You can just go to the general market and purchase this share for $43, or wait for a pullback and then purchase the shares, because that makes sense. Okay. Always this is important here, that when you're exercising an option contract, you know what the break-even price is. Now, there's one additional thing that I want to mention here. So in this calculation, I did not include any broker-related fees, exercise fees, or whatever that is that you get charged by your broker for completing this transaction. Exercise usually involves a fees, so I did not include those fees for simplicity here. So essentially, if you actually go through with the exercise, you may be charged a little bit more too. So at that point, you may want to consider, is it really worth to exercise this position or just buy it from the regular market, directly? Okay, so that's break-even price. And as a investor looking to exercise your option, this is a very important concept to know. But if you're a day trader like all of us here, we just trade options. Break-even price is not that relevant for you because you don't exercise your option to purchase the share. You're just buying options and waiting for the price to move in your favor. If you're buying call, you're predicting a breakout happening, you're expecting the stock price to go up. Once the stock price goes up, your premium value is going to increase. Meaning if AMD actually went up to 42 or 44 or something like that, this $1 premium is going to rise to $2 or $2.50 or something like that. And you can actually sell that to another buyer in the market and realize profit. So if this $100 turns into 150, so 250, you make a $150 profit for that position. Okay, that's the power of options. As price moves in your favor, your option contract's premium is going to shoot up as well, and you can actually realize profit by selling it to another player in the market and move on to the next trade. So in those cases, break-even price is not relevant because you are not exercising your contract. Okay, I hope that this concept is clear. All right, I think we've covered some enough terms. Now we can jump down to what are the different types of options. There are two types of options available. We've briefly mentioned both of them. One is call option, another is put options. Call option gives the buyer the right, but not obligation, to buy shares of the underlying security at the strike price specified in the option contract. Investors buy call options if they believe the stock price will rise by a certain amount by expiration date. Investors will be able to profit by selling the option contract if the stock price moves in their favor. That's options trading. That's what we do. Investors will also have the right to exercise the option contract and purchase shares of the underlying security at the strike price specified in the option contract. This is fairly straightforward. You guys should know this. But call option means you get the right to buy shares of the underlying security at the strike price specified in the contract. Generally, if you buy call options, you believe that the stock price is going to rise, meaning stock is going to go up, it's going to rally, it's going to go up uptrend. And that's when you buy call options. There's two options where you are available. You can either trade those options, meaning you can make profit by selling those options for a rise in premium, or you can, if you're an investor, you can also exercise the option contract and purchase shares of the security that you desire. Okay, so that's a call option contract. Now let's look at this example here. So this is a very nice example. Now let's say you bought Pins, that's Pinterest, it's a social media company. The Pinterest $20 weekly call option at $2. So weekly call option meaning that contract expires end of the week. So if someone says I'm buying weekly calls or weekly puts, it just means that those contracts expire at the end of the week. It's the current week. Okay. So let's say you bought Pinterest $20 weekly call option at $2 when Pinterest was trading at $20 per share. Okay. So typically when you buy a call option, you want the stock price to move up, and you bought Pinterest right around here when Pinterest was trading at $20 per share. Okay. And you paid $200, that is $2 to purchase one contract. Remember, $2, it's quoted on a per share basis. So 2 into 100 is what you actually pay to purchase this contract. So when Pinterest was trading at $20, you pay $200. And $200 is what you stand to lose at max. So that's your max loss. So if things absolutely do not go in your favor and you decide to hold it until expiration, decide not to sell or cut loss or follow any kind of risk management, that's your max pain, that's your max loss. 200 is all you can lose. You cannot lose more than that. Okay, so that's the power of option. You only stand to lose what you risk. Okay, So $200 is what you stand to lose. You buy here, meaning you buy at $20. Now, we're not going to talk about losses in our first lesson. We're going to be very optimistic. And let's say we bought a call option at $20 and the stock price actually started to rally in our favor, started to move up. And as the stock price moves up, our option premium is also going to increase. So when we bought it, if it's at $200 and the stock continues to rally, our $200 is going to gain value, meaning $200 may become $300, $400, $400, and $500, and so on and so forth as the stock price continues to move up. Okay? Now, at some point, you may, as a day trader, if you're trading options using technical analysis, you may just want to take profit. If you make a good percentage return, you may just want to take profit at some point here or wherever it is and realize that profit and move on to the next trade. But if you are an investor and you want to actually exercise this option contract, you may just continue to hold that option contract and see where Pinterest expires at the end of the week. And in this case, Pinterest actually expires. Pinterest actually rallied to $24. From 20, it went to $24, and at expiration, that was its price. So you can clearly see that Pinterest actually gained intrinsic value, meaning this was the break-even price. So you paid $200, and $20 was the price per share. So at $22, you made break even. You broke even here, meaning 20 plus 2. Remember our formula from our previous slide, this slide here. Strike price plus the premium paid is the break even price of the call option. And $20 plus 2 over here, $2, that is the premium paid here. So once we hit this point here, you broke even on this trade. But in this case, Pinterest actually continued to rally and gained even more $2. Okay, so you stand to profit $200 from this trade. Okay, so as the stock price continues to go up at expiration, if you decided to exercise your contract and purchase 100 shares of PINs, you actually made a profit of $200. I say 200 because remember, although the stock gained $400 from the current average, you have the $20 call option. So you had an average of $20 per share when you exercise this contract. Current value of the stock is $400. So me technically, 4 into 100 gives you $400 profit. But remember, you paid $200 to purchase this contract in the first place. So 400 minus 200 will give you $200 profit. Okay? So that's the net profit for your position if you decide to exercise this call. Okay, if you are an investor. Now, if you're just a day trader, you can sell it whenever you want and move on to the next trade. That's the power of options. You don't have to purchase anything. You can just sell it to another player in the market and then move on and realize your profit. Okay, so this is a good example for call option. Hope you guys understood this concept. Now, let's talk about put options. So call option gives you the right to buy or buy your shares at the under strike price specified in the contract. Put option gives you the right, not obligation, to sell shares of the underlying security at the strike price specified in the option contract. Investors buy put options if they believe the stock price will fall by a certain amount by the expiration date. Now, when you're trading in the market, contrary, like if you're a new beginner, you don't always have to buy low and sell high. So sometimes if you think that the stock price is going to fall, you can actually short the stock or buy put options. So that's a very good thing because you can make money in both directions. If the market goes up, you can make money. The market goes down, you can still make money. So that's the power of options and the stock market. You can make money in whatever kind of market it is, you can make money. Investors buy put options if they believe the stock price will fall by a certain amount by the expiration date. Investors will be able to profit by selling the put option contract if the stock price moves in their favor, meaning if the stock price continues to fall, you can sell your option contract to another buyer in the market and realize profit. That's options trading. As an investor, you will also have the options to exercise the put option contract and sell shares of the underlying security at the strike price specified in the option contract. Now, let's say you have 100 shares of Apple. Okay, let's say you had that 4 days back. Now, stock market actually, NASDAQ actually had a very big pullback recently. And if you had those put option contract, you could have actually exercised your option and sold shares of the option, your option, Apple shares at the strike price specified in the option contract. So the strike price was $130, and Apple actually like dropped to $110, you actually would have executed sold those shares at the higher strike price, at the higher price as specified in the option contract. So that's the power of put options. As an investor, a lot of people buy put options as hedges and as a safety measure, because if sometimes things don't always go up, stocks don't always go up, there will be pullbacks, there will be retracements, and it's a very important hedging measure taken by a lot of hedge funds and investors uh, in their portfolio. Okay, so one other thing, both call and put options are available as stock options, which is what we'll be covering throughout this course. But there are also index options, future options, and currency options. That's the Forex market. You can also trade options there. The same basic concepts apply there, but based on the instrument, there may be one or two dissimilarities. Okay, now let's look at the put option example. Let's say you bought Uber $40 weekly put option at $3. Everyone knows Uber, it's a company, it's a ride sharing company. And let's say you bought the $40 weekly put option for $3 at 300 bucks when Uber was trading at $40 per share. So you bought it here, $40. You bought the Uber put option for $40 per share, and you paid $300 to purchase that contract. So that's your max loss. Maximum you stand to lose $300. Now, when you buy put option, you want the stock price to go down, meaning you want the stock price to decline, fall, go to a downtrend. That's your goal. You're expecting the stock price to fall. And if things actually don't move in your favor and they started to rise and rally, you're going to start losing money because your premium is going to decay and lose value. And if you decide not to cut your loss, your maximum loss is $300. But we're not going to talk about the negative scenario here. We're going to talk about be positive. And let's say Uber actually starts to fall, it starts to drop as you bought this contract. So what's going to happen is your contract is going to gain value as the stock price continues to drop. So when you bought it, it was $40 per share, and your contract is $40 weekly put. The stock price continues to fall. If it moves to 39, 38, 37, your contract is going to gain value. And as the stock price keeps falling, your option contract is going to gain premium. So if you bought it at $300, it's going to be 350 here, 375, 400, 500, 600. As the stock price continues to drop, your premium is going to rise. And at some point, if you're just happy with your profits, or if it hits the key selling area, you can just take profits, sell that option contract to another buyer in the market and realize your profits, move on to the next trade, and take your profits. That's one option. As a trader, that's what you'll do. But like I said, if you're an investor, you have the right to sell your shares at the strike price specified in this contract. So if you have 100 shares of Uber, then you have the right to sell 100 shares of Uber at $40 per share. Let's say Uber actually expired at $34 per share. So you have the right to sell Uber at $40 per share, even though Uber is currently trading at $34. Now, whoever wrote this contract has the right to obligation to buy this from you. Okay, so you don't have to worry about that. I'll cover that when we're talking about options writing. But as a buyer of put option, you have the right to sell 100 shares of Uber at $40 per share, and even though Uber's trading at $34. So in this case, break even is at $37 because $40 was the strike price and $3 was the premium. 40 minus 3 is $37. That's where you broke even. And stock price continues to fall, you will be in the money and profitable. You can actually exercise your contract and make money. Okay, so I hope you guys understood this concept. So basically, you buy call when you expect the stock price to go up, and when you buy put, you expect the stock price to go down. If you're an investor, you buy call option, and if you exercise, you have the right to buy shares. If you're an investor and you buy put option, you have the right to sell shares. Okay, so I hope that covered the basics. Now I'm going to cover another important concepts here. Before I cover how options are priced, I want you to know what in the money, at the money, and out of the money strike prices an option mean. So the picture that you see here is actually what we call as an options chain. Okay, so if you go to this actually was taken at barcharts.com. If you go to barcharts.com, you have the option chain there. So this is a company called Baidu. It's called the Google of China. So this was an old options chain. You can clearly see the date 4/24. The left side, you have all the call options. On the right side, you have all the put options here. So in the middle here, you see what the strike price of those contracts are. So we see $97 strike price. So $97 call option is listed here. $97 put option is listed here. So currently, Baidu is trading at $105 per share. Okay. So what is in the money option? So for in the money option, a call option is considered in the money if the current stock price is greater than the strike price. So the current stock price is $105. So what is the strike price? It's greater than the strike price. So you see this green box is here, this green box. The stock price over here is 105. So all these strikes here, all these option contracts here are considered in the money because clearly see the strike price here 97, 97.5, 98, 99, 100, 101, 2, 3, and 4. All these prices here are lower than the current price, meaning if you have this contract here, let's say you have the $103 contract, and currently Baidu is trading at 105, meaning it's already profitable, it's already in the money. Okay, so that's why we call it as in the money. It's already profitable. You have a strike price that's lower than the current strike price of the stock. That's why we call it as in the money. So if you open an options chain, just check the stock price. You scroll up, anything above the current stock price is called as in the money contracts. And similarly for put option, so current price of the stock is 105. So put option is considered in the money if the current stock price is lesser than the strike price. So over here, stock price is 105. So anything above 105 is considered put option. Is considered in the money. Remember, when we're buying put option, we want the stock price to go down. So if the current price is 105 and we have a strike price 108 or 109, we are already in the money because we have the right to sell our our shares at a higher price than the current price of the current stock price of the market. So those option contracts will be considered as in the money. Over here in this case, 105 is the current stock price. So anything above that is considered as in the money option contracts. Okay. I hope that this is clear. It's fairly straightforward. Once you gain more and more experience, you will know what in the money means, and because it's just based on that, and we call it in the money because those contracts are already profitable based on the current market price. Okay. At the money option is very straightforward. It's just as the name implies, a call or put option is considered at the money if the stock price is the same as the option strike price. So this example is over here is very nice because the stock price is 105 and we have a 105 strike price. So this option contract here, both the call and put option is considered at the money. So currently the stock price and the option contract strike price, they're at the same price, so we call it as at the money. But generally in the market, anything close to any strike price close to the current price is widely considered as at the money option contract. So sometimes you don't have such a nice spread options chain. Sometimes you'll have 100 in a different in a widespread contract. You may have in an illiquid options chain. You may have 105 strike, then you'll have 110. You may not have 106, 7, 8. So in those cases, something around whichever strike price is closer to the current strike price will be considered as at the money. Okay. I'll explain more about this concept when I go over Greeks in a future lesson. But for now, I just want you to know what at the money and in the money options are. So what is out of the money option? Now, the call option is considered out of the money if the current stock price is lesser than the strike price. Current price is 105. And you can clearly see that 106, 7, 8, 9, 10, 11, I just have this marked under this green box. We are calling this out of the money because it's a future price. So currently the stock price is trading at 105. So if you buy a $110 call option, you're buying something out of the money, meaning that option contract that you're buying is not yet profitable. It's a future price. It may get to that price at the end of the month or end of the option contract period, but that's not still out of the money and it's not profitable yet. So just think of a real life example here. You buy the $110 call option, okay? When Baidu was trading at 105. If you decided to exercise that option contract and buy Baidu shares at $110 per share, you will immediately be in loss. You will not be in profit, because currently Baidu is trading at a $5 deficit, meaning there's a $5 gap between the current price of the stock and the current price of the option contract. So there's no need for you to buy it, exercise this option contract at all. Now, that's why we call it as out of the money. So in this case, previous case, we say this as in the money, because if you decided to exercise these contracts, these are already profitable, meaning current price of the stock is greater than the strike price. That's why we call it as in the money. Over here, these are not profitable yet. That's why we call it as out of the money. Now, by the time the contract expires, Baidu might have gone to 120. Then then these contracts will be in the money, considered in the money, because they're profitable. Okay, I hope that this concept is fairly straightforward, but once you understand this, it's very easy. It may be a little hard at first, but once you understand it, it's fairly easy concept. So put option, same thing. Put option is considered out of the money if the current stock price is greater than the strike price. So currently stock price is at 105, 104, 3, 2, 1, 0, 99, 98, 99, 97, they're all considered out of the money. Remember, when we buy a put option, we want the stock price to fall. So currently you have 105, currently the market price is at 105, and you have 104,321. It's a future price, meaning the stock has to fall to these levels for it to be profitable. Meaning, if you want to sell 100 shares of Baidu and you have the $100 put option, you can rather sell it at current market price than exercise this option contract, because this is not yet profitable. Okay, so if at the expiration date Baidu actually drops to 97, then it makes sense for you to exercise this contract and sell your shares at 100. Okay, so that's why this is called an out of the money put option. I hope that these concepts are clear. It's very widely used term, especially in the world of options: in the money, at the money, out of the money. So this is, I hope you guys understood these concepts. I try to break it down as easy as I can, but we don't worry if you didn't, because we'll be using these terms a lot, and I'll be going over this, how these different contracts are priced and how they move when I go over Greeks. Now, this is an interesting and important section of today's lesson: understanding options pricing. Now, before you jump into buying options, you need to know how option premiums are priced to better understand the risk and reward in using this underlying instrument. So before you buy or sell, you need to know how they are priced. So meaning, let's say you pay $200 to buy a call option contract. What exactly are you buying? Are you, why is that option priced at $200? Why is a different strike price priced at $150? Why is another strike price priced at $300? What's the difference? What are you paying for? You need to understand all of those before you actually start trading options. Remember, options is considered a lot more risky than buying shares, because shares do not expire. Options do. So if you put money into your options, you can actually lose all of your investment by the time if the contract expires. But shares, there's no expiration to shares. You can just buy shares, and if price actually drops, you can just hope that price will bounce back. If it's a good stock, good company like Apple, Amazon, Facebook, Google, it's going to bounce back again, and in 5 days or 10 days or even 1 month, it'll bounce back and you'll be profitable. But options, you don't get that luxury of time. So you need to know exactly what you're paying for, and you need to know the pricing behind this the contracts. Okay. So now let's see how the options are priced. Option premium, that's the price you pay for option contracts, has two main components. It has an intrinsic value and a time value. Option premiums has an intrinsic value component and a time value component. Intrinsic value is the amount by which the strike price of an option is profitable or in the money. Example, we just saw that what in the money means. Baidu's spot price is at 105, meaning currently Baidu is trading at $105. Let's say you select the $103 call option, meaning the intrinsic value of this option is $2. So 105 minus 103, that's $2. How did I find that? Remember, I told you that when you have a contract that's already in the money or profitable, you know what the difference is. So if the current price is 105, you just have to subtract the spot minus the current strike price, and you get $2. So that's the formula here. So intrinsic value for call option is maximum of 0, minus spot minus strike. You get the value, strike minus spot minus strike. And intrinsic value for put option is maximum of 0, strike price minus spot price. So that's how you calculate it. Don't worry, I'll explain what this maximum and zero stands for in the next slide. But these contracts that are already profitable are, and has some kind of intrinsic value based on the current market price is why we call those as intrinsic value. And if your contract is an in-the-money contract, it will have an intrinsic value component to it. So in this case, contract has a $2 intrinsic value component. Another important concept is intrinsic value is portion of the options premium that is not lost due to the passage of time. Options intrinsic value depends only on the stock price. So if you noticed here, this formula, it has no time value component to it. It's just looking at what the spot price is, meaning what is the current price of that stock. And it's going to take into account the strike price, that is the strike price of your option contract. Nowhere here are we talking about time, meaning what is the expiration date? When does it, how long does it, how long do we have before expiration? We're not talking about any of that stuff here. So intrinsic value only depends on the option strike price and the stock price of the stock, current price of the stock. It does not depend on the time remaining until expiration. So this value here does not, you do not lose this intrinsic value due to the passage of time. So if you have an in-the-money option contract and you write it to expiration date, you may lose all of the time value tied to this option contract, but the intrinsic value will still be there. Okay, you'll understand this once I go over the next two slides. But intrinsic value is something that you do not lose due to the passage of time. Okay. Now, time value is the second component. So if you pay $200 for an option contract or $300 for an option contract, it's going to have an intrinsic value component and a time value component. Okay. So intrinsic value, it deals with the pricing of the stock based relative to the option strike price. That's how intrinsic value is calculated. And time value can be defined as the portion of the options premium attributed to the time remaining until the options expiration date. It can be calculated by options premium minus intrinsic value. Time value is also referred to as extrinsic value since it decays over time. Okay, so I want to explain some interesting and a good concept here. How time value is priced. So this formula here does not exactly tell you what comprises of time value. It says that you just have to subtract the option premium minus the intrinsic value and you'll get the time value. Okay, so in this case, let's say you pay $200 for that option contract and it's already in the money. So if you subtract that, let's say $100, so $100 is the time value component. So 200 minus 100, time value is $100. But what exactly is that $100 comprised of? Now, that you will understand when I go over Greeks. So what comprises of time value? What are the components of time value? Like how is that time value actually, what is that $100 exactly comprised of? You'll understand that when I go over Greeks, which is in a future lesson. But essentially what I want to convey here is that option has a time value component and it decays over time. What does that mean? When you have purchased an option contract, right after you purchase it, it starts losing some value. So once you buy an option contract as a buyer, you're already playing defense, meaning the time value of the option contracts will slowly decay over time. So the longer you hold the option contract, it's going to start losing its value slowly, this time value component. Okay, so we paid $200 and 100 value is attributed to time value. That $100 is going to decay slowly over time. And by expiration date, as it approaches expiration date, it's going to exponentially decay to $0. Okay, all the time. There's no exceptions. All option contracts, as it approaches expiration date, the time value of that option contract is going to expire to zero. So if you paid $200 for this option premium, $100 for intrinsic value and $100 for time value, this time value here will drop to zero by expiration date, period. There is no exceptions, no nothing. It will drop to zero by expiration date. Intrinsic value only depends on the stock price and the strike price. So if it has intrinsic value, if the option contract is profitable by the expiration date, it's going to have intrinsic value, but no time value. Okay, so that's what we call as time decay. Options lose their value as it approaches expiration date and inevitably drops to zero exponentially. So as time progresses, your option contract's time value is going to decay and lose its premium slowly, and at expiration it drops to zero. Now I want to tell you what that means. So when I say this $100, it comprises of stock prices. There's a lot of Greeks tied to time value. So we have theta, we have delta, we have gamma, we have rho. So we have a lot of Greeks tied to it, and each of those represents a property of these option contracts. So based on price movement, based on time movement, based on how fast it moves, your options time value is going to change variably. And I'm going to teach you how these time value react to price changes, time movement, and speed of movement when we go over Greeks. For now, I want you to know that this time value component is always going to be changing and is always going to be dropping. And at expiration, it goes to zero. Okay. Now let's take a look at this example to understand both intrinsic value, time value for both in the money and out of the money option contract. So the same example, Baidu is trading at $105. Now let's consider the $103 in the money call option. Let's say we purchase it for $3.80. So the $103 call option is $3.80. That's the last traded price, LTE. And $3.80, that is $380 you pay for that. And to calculate the intrinsic and time value, the intrinsic and time value can be calculated for, first the spot price is 105. You subtract that with the strike price, that is 103. You get $2 as the intrinsic value. And for time value, you paid $3.80. That's the premium. And if you subtract your intrinsic value, you get $1.80. So if you purchase the $103 call option, you are paying $2 for intrinsic value and $1.80 for time value. So what does that mean? Now, if Baidu continues to rally, meaning continues, if it's at 105, it continues to go to 110, 115, and so on and so forth, your option contract is going to gain intrinsic value. Meaning currently intrinsic value is at $2 based on the the spot price of 105. Now if it goes to $110, your intrinsic value is going to gain, it'll be $7, meaning it's going to be 700 bucks. Okay, that's a lot of money, right? As the stock price continues to go up, it's going to gain intrinsic value. But time value here, the stock price may go to 110, but as time progresses, this $1.80 is never going to go up. It's always going to drop. Okay. So once you purchase this time value for $180, this time value is going to drop. It's going to drop to 175, 170, 165, 150, so on and so forth. And by expiration date, it's going to drop to zero. Okay. Now that's why it's important that you know the expiration date. If you purchase a contract very close to expiration, you're not going to be paying much for time value because the contract is going to expire pretty soon. So your premium for time value is not going to be high. That's why when you purchase option contracts on Thursdays, contracts are cheaper because the contract expires next day. Time value component attached to the premiums is very low. So you're not going to be paying much. Okay. That's how options are priced. And in this case, you will be paying $2 intrinsic and $1.80 for time value. If the stock continues to go up, your premiums will increase based on the intrinsic values increase, but your time value is not going to increase because it's going to drop as time progresses. Now let's consider the 109 out of the money call option at 101. Okay. Over here, we have 101 out of the money call option. Currently, the stock is trading at 105. 109 is a future strike, future price, so it's not profitable yet. That's why we call it out of the money. So we calculate the intrinsic value here. 105 is the spot price. 109 is the strike price. You get a negative value. So you get a negative number here. Now, based on our formula, what did I say? Intrinsic value is equal to maximum of 0, spot minus strike. So if you actually do that, the maximum of 0, minus 4. So which is greater? 0 is definitely greater than minus 4. So that's why we take the maximum of those two numbers. That's the 0 value. So intrinsic value for out of the money option contracts will always be 0 because they have no intrinsic value. They're not in the money So that's why we always have the intrinsic value component as 0. Now time value is, you can calculate that by subtracting the premium and the intrinsic value. So 1.01 minus 0 is equal to 1.01. Now you clearly see that this option contract is much cheaper than this 103 in the money contract. The reason it's cheaper is because you're not paying anything for intrinsic value. All you're paying is for time value. And if the stock moves in your favor, meaning, let's say you bought the 109, right? Now the stock actually moves in your favor, 110, 115, 120, or so on and so forth. Your option contract is going to gain intrinsic value, and your premium is going to shoot up. So if you bought something out of the money and it becomes in the money, that's why your contract value rises so much, because it's gaining intrinsic value. It's becoming profitable, and that's why your contract's going to raise value. So if you buy an out of the money contract, you're going to make money. Your options are going to gain a large percentage return. Okay. Now the con side for this purchasing out of the money is, if the stock price does not move in your favor quick enough, your time value is going to decay a lot faster, and you're going to lose a lot more in premium. You don't have intrinsic value, your time value is going to decay a lot sooner, and you're going to be losing your premium as well. So it's important that you know how to purchase these option contracts based on the current price, and consider the Greeks in question. You will understand the Greeks portion. I cover that in detail in a future lecture, so don't worry. But I hope that you guys understand how these premiums are priced here, at least in a high level. Okay. Now we're coming towards the end of the lesson. So now I'm going to be talking about writing options, that is selling options. So what is options writing? Options writing is a strategy where an individual writes or sells an option contract to a buyer in the market to collect the premium for option premium fees. So remember I said that to transact in the financial markets, there needs to be a buyer and a seller. Okay. So when you're buying an option contract, someone actually needs to write that option contract in the first place. So meaning someone should be willing to facilitate that transaction. So in this case, someone, remember the sneaker example, Sam should be actually willing to sell you shares of that underlying security. So in the case of options writing, someone needs to be actually willing to fulfill that transaction. So when someone actually writes an option contract, instead of paying premium, they actually collect premium. So when you buy an option contract, you pay the option premium, and the writer actually collects that premium. Okay, so we buy a $100 call option for Apple and pay $200 per contract. That $200 actually goes to the writer of that option contract. Okay, so the writer actually collects the premium for that option contract, for that transaction. So when an option writer writes an option contract, they are agreeing to buy or sell, depending the type of option, the underlying shares or the security at the strike price, should there be an assignment. So if someone, if an option buyer out there, they purchased a call option, let's say for example, and they decided to exercise their option contract to purchase 100 shares of Apple at the strike price specified in the contract. So there will be an assignment, meaning the writer of that option contract will be assigned, and they have the what is that? What is the right word? They have the need to actually fulfill that the right to sell that Apple shares for that strike price specified in the contract. For example, if $100 strike price is the strike price for Apple, they have the right to actually fulfill that transaction at $100 per share. Meaning, if they have 100 shares of Apple, they'll have to sell that 100 shares of Apple at the strike price specified in the contract. So that's essentially the basic concept of option writing. So we have a lot of classifications here. So options in general, you can buy or write options. Alternatively, writing is also called as selling. So you have a call options for buying and put options in buying, which is what we covered earlier in the lesson. In writing, similarly, you have call options and put options. You can do covered calls, you can do naked calls, you can do covered puts and naked puts when you're writing options. So I'll be covering all of that in the next few slides. So writing call options. So when you're writing call options, the writer collects premium and agrees to sell shares of the underlying security at the strike price specified in the option contract. Now let's take a look at this diagram here. This one actually gives you everything. So when you're buying call, buyer has the right to buy the stock. wants the stock price to go up, that is appreciate in value, buyer pays the premium. So we covered this in the previous, earlier in the lesson. So when you buy a call option, you want stock price to go up. You have the right to buy the stock if you decide to exercise. And as a buyer, you have to pay the option premium to purchase that contract in the first place. Now, if you're a writer or a seller, what you have to do is you have the obligation to sell the stock. So as a buyer, you don't have the obligation, but as the seller, you do have the obligation if you are assigned to sell stock of the underlying security. You want the stock to depreciate in value. That is exact opposite. If you're selling call options, you want the stock price to go down. You're on the other side of the transaction, meaning you don't want to be assigned. You just want to collect the premium that you received and just want the contract expire worthless. Okay, and the seller collects the premium here, and that's the sell side. All right. So there is a common saying that in the options world, uh, I always said that time is against the buyer in the options world. So when you buy a contract, the moment you buy it, time is not in your favor. As time progresses, your contract is going to depreciate in value. But as a seller, time is in your favor because you want those contracts to expire worthless. And the moment you sell those contracts, the time value component actually going to be working in favor of the seller. Now, let's take a look at this example here, which will help you guys make sense of this whole concept. So Apple naked call. Now let's assume John wrote an Apple $300 call option expiring 5/15 to receive a premium of $4. What does this mean? So John decided to write a $300 call option. So the reason for writing that option may be because John would have expected, well, this is an out of the money call option. By expiration date, there's no way that Apple's going to go above 300. I might just write this option and collect the premium of $4. It's basically free money. So let me just buy this. There's no way Apple's going to expire about 300. John's confident of the trade. So he decides to write this call option expiring 5/15. And once he writes it, the buyer of this option contract is going to pay $400 to John. And John has that $400 without any worry. So $400 will be credited to his account. He has it in his, it will show up in his balance. On 5/15, that is the day of the option's expiration, Apple closes at 310. Well, John had a surprise there because Apple actually rallied like crazy and it closed $10 in the money. So the $300 call option expired $10 in the money at 310. So what happens? Whoever bought this call option, whoever has this call option currently may choose to exercise that call option. So John is obligated to sell 100 shares of Apple at $300 per share. Okay. So since John wrote the option, he has to sell those 100 shares of Apple at 300 per share, assuming he is assigned. In this case, obviously he will be assigned because someone is going to exercise this contract. It's expired so far in the money, so it's most likely going to be assigned. So John, since it's a naked call option, meaning John does not have 100 shares of Apple to sell. So what will John have to do? John will have to purchase 100 shares of Apple at current market price, that is at $300 per share. So once John purchases at 100 shares of Apple at $310 per share, he can actually sell it to complete his assignment. He can sell it to the other guy in the transaction. And so what will happen? 310 minus 300 based on the current market value. That's the intrinsic value of the option. So John will lose $1,000. John will lose $1,000 then and there because of this transaction. So he bought shares at $310 and he sold it at $300. So that's $10 loss into 100. That's $1,000 loss on that transaction. And the thing that actually reduces John's net loss is he collected a premium of $4 in the first place to write this option. So he actually didn't lose that much. So 1,000 minus 400 is $600 is what John lost in the trade. Okay. So if John got assigned and the stock actually was expired in the money, John will have to purchase those shares and is going to sell it at a loss and he's going to lose some money in that trade. Scenario 2. Now John was right and Apple didn't close about 300, meaning it expired worthless. So if Apple actually closed only at 298, if Apple closed at 298 on 5/15, then the option contract will expire worthless. Remember, if it didn't have any intrinsic value, time value is going to expire to 0, so the contract is worthless at expiration date. So John made a profit of $400. That's the premium he received. He didn't have to buy shares. He didn't have to fulfill his obligation. He just made profit out of that premium. And he was right. The Apple didn't close above 300. Okay, so that's the scenario over here for writing call options, naked call options. And I hope that this is clear. Essentially, you can write a call option to collect the premium. The stock price didn't expire in the money. You can just keep the premium and move on. If stock expired in the money, you will be forced to, you'll be assigned, and you're obligated to sell shares of the security to the other person in the transaction. Based on where the stock price closed, the stock price was just you have to stock. So based on where the stock price closed, your loss will be either small or significant. Okay. So what are the differences between writing naked and covered call option? So we discussed naked call option. So what is covered call option? Writing naked call is a strategy of writing a call option without owning the underlying security. So in this case, John had to buy shares at current market value and fulfill his obligation. But if we had covered call option, meaning if John already had shares of Apple, he could have just used those shares to complete the transaction. And if those shares were at a lower average, he wouldn't have lost this much money. Okay, so that's the difference between covered and naked call options. So I want to call out one main, very important thing about writing naked. The risk associated with writing naked call options is infinite, as the stock can technically go to infinity. So in this case, John got a little lucky because Apple just went to 310. If John actually wrote a call option, naked call option on a crazy stock like Tesla, and Tesla grabbed $100 or $200 overnight, then John might have been screwed because he would have taken a big loss. And the big risk associated with writing naked is that stocks can technically go to infinity. So anything can happen overnight. And you got to be very careful when you're writing naked, because if you don't have the shares, you'll have to fulfill that obligation, and you have to purchase at current market value. Whatever the stock price goes, you'll have to purchase it from there. And fulfilling that obligation may break your account. So it's very important. So that's why writing covered calls is a strategy. It's considered a much safer strategy, because at least you have the shares to fulfill your obligation. Although writing naked is considered risky. Okay, so that's the difference. Now, what is writing put options? Writing put option, when you're writing put option, the writer collects premium and agrees to buy shares of the underlying security at the strike price specified in the option contract. So when you're buying puts, you have the right to sell stock as a buyer. You want the stock price to depreciate in value. The buyer pays the premium. As a seller of a writer of an option contract, seller has the obligation to buy shares of the underlying security. You want the stock price to appreciate in value, and the seller collects the premium. So if you have a put option as a buyer, you can sell shares at the strike price specified, but someone out there should be buying that shares. That buyer is the writer of that put option. They have the obligation to buy that stock, even though it may be at a loss. They'll have to fulfill that obligation. That's what the writer writing a put option means. So let's take the same example here. John, suppose John wrote NVIDIA $300 put option expiring 5/15 to collect a premium of $5. Okay, on 5/15, NVIDIA closed at 290, meaning NVIDIA price actually dropped. Remember, at a put option writer, you want the stock price to appreciate. You want the stock price to go up. In this case, John was unlucky again. Stock price actually dropped, and it expired in the money. It actually dropped below the premium as the strike price. So John is obligated to buy 100 shares of NVIDIA at $300 per share, assuming John is assigned. In this case, he will be assigned because it's expired in the money. So 300 minus 290, meaning John was forced to buy NVIDIA at 300 per share, even though NVIDIA is currently trading at 290. So he already took $1,000 loss when company completed that transaction. But the net loss for John is only $500 because he received a premium of $500 to write that option contract in the first place. So John only lost $500 on that trade, but he only lost that because NVIDIA expired in the money and he was forced to buy shares of NVIDIA at a loss. Scenario 2 here, if NVIDIA actually closed about 310, meaning it expired worthless, NVIDIA's put option is 300, so it expired out of the money, then the put option will expire worthless. John would have just banked off of that premium of 500. He wouldn't have had to fulfill his obligation, and he would have just collected that premium. So the option contract expires worthless. The writer gets to keep the premium, doesn't have to fulfill any obligation. But if the option contract expires in the money, then if he gets assigned, he will have to fulfill his obligation. And based on where the stock price closed, the loss may be either small or significant. So what is naked put option writing? So the example that we saw there previously is what we call as naked put option. Writing naked put involves writing put option without shorting shares of the underlying stock. So remember, when someone says shorting stock, you're just borrowing shares, and the same effect as put option. When you're shorting something, you expect the stock price to go down. You should borrow shares at a higher price, and when the stock price drops, you're fulfilling that position. You're flattening that position, buying back those shares, giving those shares back, and you're completing the transaction over there. So that's what you call as shorting. You'll be in a negative position at the start, and once the short is complete and you're ready to take profit, you can just buy back those shares and complete that transaction. So in naked put options, you're not doing that. You're just writing puts. You're not shorting shares of anything. So when you're writing put options, you want the stock price to expire worthless. If the stock price expires in the money, then the writer gets assigned and they will have to buy back shares of the underlying security, which is what John had to do here. The risk associated with put option is high should the option not expire worthless, as technically the stock can go to zero before expiration date. So the example here is, so John actually wrote Hertz $10 put option, and Hertz dropped to $1 at expiration. Remember, Hertz is a company that filed for bankruptcy recently, and their stock just took a big nosedive. And so in cases like that, if you're a writer, you may get screwed because he wrote the $10 put option and Hertz dropped to $1. It's practically worthless. John will have to buy 100 shares of Hertz at $10 per share and fulfill that obligation. But Hertz's current market value is $1. So the stock may never get back to $10. So he'll be bag holding something that's going to be bankrupt, may expire, it's already a penny stock, it may drop below $1 and maybe even be delisted. So something like that is dangerous because stocks can go to zero. But unlike naked call option, your loss is capped at zero because stocks can only go to zero, cannot go to infinity. So it can only drop until zero. So your loss is at zero. It's not as bad as the naked call, but naked put also it's very dangerous because you'll be holding an asset and of shares of something that's practically worthless. So this is just a graphical example of the same thing. So when you're writing put option, the premium you collect, that is the maximum possible profit. So the premium that you collect for writing the put option, that's your maximum profit. So when you're writing any call option or put option, the premium you collect is your maximum possible profit. If the stock expires out of the money, you're well and good. You get to keep that premium. You don't have to worry about assignments and obligations. But if once the stock option actually breaks even from the buy side, you may get assigned, and the more the stock price actually rallies, you stand to lose a lot. The more the stock price drops, you stand to lose a lot because you will get assigned and you will be forced to buy something, and your risk is unlimited risk to $0. That's what I explained here. Okay. Once an option break evens on the buy side, you stand the risk of losing money because on the buyer side, who they're going to want to exercise that option, and you may get assigned. And once you get assigned, you will have to purchase shares to fulfill that obligation, thereby putting you at a risk. Okay, so that's naked put option writing. What is covered put option writing? So writing covered puts involves writing a put option while shorting shares of the underlying stock. That is short put and short shares. What does that mean? We already talked about what writing general put is. Writing a put means you're just writing a contract and you will be fulfilling that contract. If you're assigned, you'll collect a premium. Same concepts apply here, except that in addition to just writing a put option, you'll also be shorting shares of the same stock. That's what we call as covered put option writing. So in general, when you're writing anything, we call it a short because you want the, instead of the buy side, you want to short that option. So that's you're joining the sell side of that transaction. So that's why you call it a short put. And short shares is just essentially shorting shares of that stock, meaning you're borrowing shares and you're expecting the shares to drop, and then you'll cover by buying back those shares to fulfill that transaction. So writing put involves writing a put option while shorting shares of the underlying stock, that is short shares and short put. Let's take a look at this example. Let's assume AMD stock is currently trading at $45 today, and John writes a $45 put option for a $200 credit. So John wrote $45 put option and he received $200 as credit. That's his maximum possible profit. And John also shorted 100 shares of the AMD stock when it's trading at $45, meaning John borrowed 100 shares of AMD stock when it's at $45. Okay, so it's like minus 100 right now when it's when you stay short of this share. So the net credit taken to enter this position is $200. He received the $200 credit. That is also his maximum possible profit. Wait, what? You might ask me, how is that possible? John made, instead of a naked put here where he collected premium, John actually did two transactions here. He actually wrote a put. He also shorted shares of the stock. So why is he only making $200 and why is that his maximum possible profit? You might ask me that question. Why isn't he making more money? I'll tell you why he's not making more money when I go over these two scenarios here. So scenario one, at expiration, AMD is trading at $40. So he shorted the shares at 45. He wrote the put option and he shorted those shares at $45. AMD actually dropped and it's at $40 at expiration. So the short put will expire in the money, meaning when he wrote that put option, remember when you write a put option, you want the stock price to appreciate and you want the option to expire worthless. So in this case, the stock actually dropped and it expired in the money. Okay, so currently, since it expired in the money, John will be forced to buy back those shares from the buyer at the strike price specified and take a loss. In this case, since it's at $40 and $45, so 45 minus 40 is $5 into 100, that's a $500 loss. So the short put will expire in the money and is worth $500, but this loss is offset by the $500 gain in the short stock position. What does that mean? So the option that he took expired in the money and he was forced to complete this transaction, complete his obligation, thereby losing $500. But since he also shorted 100 shares of AMD and the stock price dropped, he made $500 in this transaction. So he shorted at $45 and he covered at $40. So that's a $5 into 100. So he made $500 in the short stock position. So thus the profit is still the initial credit of $200 taken on entering the trade. His option was forced to cover. He was forced to fulfill the obligation and took a $500 loss, but a short stock position saved him and he made $500 there. So they balanced each other out and he broke even. And he actually made $200 profit because he wrote that contract and received 200 credit. So in this transaction, even though the option ended up going against him and he was forced to fulfill his obligation, he actually made money because his short stock position saved him and he received a $200 credit. That's how he was profitable. Okay, so this is a happy path scenario when you're writing covered put option. Now scenario two here, AMD is trading at $55 at expiration. So in this case, AMD's the stock option that he wrote expired out of the money. Remember, when you write a put option, you want the stock price to go up, and in this case, it did. At this price, the short put will expire worthless, while the short stock position taken while AMD was trading at $45 suffers a $1,000 loss. So how is that possible? When you shorted the shares of the stock, it was $45. Currently, it's at $55. Let's say there was an overnight gap up and AMD moved $10 overnight. So what will happen is on expiration date, so assuming it's a Friday, $55, there's a $10 gap up overnight. So a short position in the stock suffered a $1,000 loss. So if we subtract the initial credit taken, that is $200, the total loss is $800 in this transaction. So this is an example of covered put option writing. You're shorting shares as well while shorting the put option as well. Hope this example made sense. It's a lot safer strategy because you're covering your position, even though you're minimizing the damage if things go against you. But you have to be very careful and know exactly what you're doing before you take these complex multi-leg positions. Because you're doing multiple transactions, you need to work out the math behind this and know that the probability is on your side before making such plays. That's the concept behind this. I hope that this example made sense. Now, last slide here. So why do we trade options? So number one, you can generate income through option selling. So if you have a large portfolio and you have a lot of shares, you can volatility, if the market's like pretty stable right now, you can actually write a lot of options, call options, and put options and make money because you can just collect those premium. I can treat it as weekly income and collect those premiums, no matter how small they may be. You may just write those options and collect those premiums. And if you do covered writing, you can actually, it's a lot of safer strategy. You can make money, residual income just by writing options. Number two, to hedge your portfolios against major events like earnings, elections, etc. So the market's facing some kind of volatility crisis, meaning some kind of major event is happening. So it's if companies reporting earnings, the market's anticipating a big move. So the stock may actually tank after a bad earnings. If the company says that they don't expect to make any money in the future, or they're going to expecting bankruptcy or something like that, then the stock price is going to like tank. And to protect against such big price moves, you can hedge your portfolio. Remember, I said that you can buy put options. If things stock price tanks, you can actually sell your position for a higher strike price at a higher strike price. So that's one thing. Another thing is if some major event like election or something like that happens, if you have a good hedge like QQQ put options or whatever it is, so if it's you're protecting against a big downside move, you can buy put options or invest in short positions like VIX or something like that. And if price moves in your favor and market has some volatility, your portfolio will be hedged, your positions will be protected to minimize losses. So that's another reason for buying options. And the main reason that we actually trade options is the return on investment is higher when trading options, higher percentage of return for a smaller move in the underlying security. So every day you don't see stocks moving 10%, 20%. Maybe someday you'll see it, but it's not a regular phenomenon. So if you want to make actual money trading equity, that is stocks, you need to you need to have a large capital invested in those stock positions and make those small percentage return. But options, on the other hand, is a derivative instrument. So for a smaller move in the stock, your option contract is going to gain, the premium in the contract is going to gain a large value. You're going to gain a large percentage of return for a smaller move in the stock. And you don't have to invest a lot of money to purchase an option. So you make a large percentage return for a very small move in the security on an intraday basis. The return on investment is very higher when compared to trading option, when you compare options and trading security. That's why a lot of people like options trading. And the maximum loss is also capped when buying options. You only stand to lose what you paid in premium. So if you're investing in stocks, let's say you have a $1 million stock and the stock actually tanks 10% on one day. That's a lot of money when you're losing on just overnight. And you put a lot of capital in that, and you're exposing your portfolio to a big price move in the market. That's a risk that you're taking. But if you're just trading options every day, let's say you buy a call option contract for $200, your max loss is at 200, but if you have 100 shares of the same thing, 100 shares of the same stock like Apple, for a small move, you're going to lose a lot of money. Okay, that's another thing that you have. It's options is not capital intensive, but shares is, and the loss that you incur in options is always capped based on what you put into that option. And option is also a low risk strategy when compared to investing in stocks. It's actually quite not true because options has a time value component to it and decays over time. But the reason that this is considered risky is because you lose a lot more capital to buy shares, and it's very capital intensive. You're holding the shares for overnight positions. So if you're trading overnight stock positions, that's very capital intensive. You're exposing a large portion of your account to overnight volatility that can give you big losses. And so if you're just buying one call option contract of the same stock, that is you're investing $200, that's not going to be a lot of money to lose. But if you're buying 100 shares of the contract, 100 shares of the stock that's valued at $200, that's a lot of money, and you're risking a large portion of capital overnight. So that's a risky position. If you're not hedged and some kind of volatility happens, you may lose more money than when you compare to just losing one call option contract value of the same stock. The risk in owning shares is also that you can lose 100% of your investment as stocks technically can go to zero. So although this doesn't happen for good companies, I mean, you can never see Apple go to zero. Something like that can never happen. Not, I hope that it never happens. But so the risk in owning shares, especially for bad companies, is that 100% of investments can go to zero. So you got to be careful, especially if you're invested heavy. I know a lot of people. I knew a lot of people who were invested heavy in stocks like L Luckin Coffee, Hertz, and all those companies, and a lot of retailers like Neiman Marcus, Macy's, and whatnot. Those stocks like just dropped and dropped. They never gain value. They're full of debt. Their balance sheet sucks, and those companies can technically still drop to zero. So if you're heavily invested in those companies, you may lose 100% of your investment. So that's a risky strategy. Of course, every instrument that you take, either it can be cash instrument, stock, or options, everything has its risk. It's how you manage those risks will determine how you're profitable. You cannot make money without risking money. Okay. Hope you guys enjoyed today's lesson. I know it's a long one, but I had to slow things down so that everyone understood these basic concepts. Throughout this course, we will be discussing a lot more advanced topics, but I hope you guys enjoyed today's lesson. Thank you.